Hi. Today we will discuss how to analyze a business using financial ratios. First of all, let's understand why businesses need financial analysis. A financial analysis will not only help you understand your company's financial condition, helping you determine its creditworthiness, profitability, and ability to generate wealth, but will also provide you with a more in-depth look at how well it operates internally. Financial analysis also identifies your company's position in relation to the sector of activity, which allows you to keep an eye on the competition. This can be useful in building an effective business strategy and minimizing your exposure to these risks. There are 5 types of financial ratios: profitability ratios, liquidity ratios, leverage ratios, efficiency ratios, and market value ratios. We will discuss all financial ratios and their individual types, their importance, and how to use them. Subscribe for more videos on financial ratios and how to use them. Profitability ratios are financial metrics used by analysts and investors to measure and evaluate the ability of a company to generate income relative to revenue, balance sheet assets, operating costs, and shareholders' equity during a specific period of time. They show how well a company utilizes its assets to produce profit and value for shareholders. The most popular profitability ratios are gross profit margin, operating profit margin, net profit margin, return on assets, return on equity, return on invested capital, etc. In this video, we will discuss what gross profit margin is, how it is calculated, its importance to businesses, and the significance of its changes. The gross margin ratio, also known as the gross profit margin ratio, is a profitability ratio that compares the gross margin of a company to its revenue. It shows how much profit a company makes after paying off its cost of goods sold. Gross profit margin is calculated by relating the difference between total revenue and the cost of goods sold to total revenue. Income, gross revenue or turnover is the total amount of sales you make over a set period. The cost of goods sold or cost of sales is the sum of all direct costs associated with making a product. It appears on an income statement and typically includes money spent on raw materials and labor. The data on the company's gross revenue and cost of goods sold can be taken from the company's income statement. Let's calculate the gross profit margin for Coca-Cola in 2021, for which we took the data from Coca-Cola's 2021 annual report. In 2021, Coca-Cola had an income of $5.6 trillion and spent $3.6 trillion in cost of sales. In that case, Coca-Cola's gross profit margin in 2021 will be 0.351. If gross profit margin analysis is calculated for only one time period, the indicator can sometimes give incomplete information about the status of the company. That is why it is important to calculate and analyze the gross profit margin ratio and other ratios continuously over time. Because thanks to such analyses it was possible to get a correct idea about the status of the company. As a result, business managers frequently employ tools that enable interactive analysis of financial ratios. ControlZenith Consulting offers such interactive dashboards. The interactive dashboards we offer are created in Excel, which allows even those without deep professional knowledge to use them. To order interactive dashboards, click on the link in the description. However, if you have calculated the gross profit margin for several years, how can we analyze it and what information can it give us? Gross profit margin dynamics can take 3 forms: increasing, decreasing, and stable. When the gross profit margin increases over time, it can indicate one of 2 things. Either the company's revenues have decreased, or its cost of goods sold has increased. There are various reasons why a company's revenue may decrease. For example, the company might sell fewer products or services, which would result in lower sales volume and overall revenue. Alternatively, the company might decrease the price of its products or services, leading to a decrease in revenue per item sold. Another possibility is that the company may face increased competition, resulting in a loss of market share and a reduction in revenue. In addition, changes in customer preferences or the market as a whole could lead to a drop in demand and revenue. Economic factors, such as a recession or economic downturn, could also result in decreased consumer spending and lower revenue for the company. Lastly, external events such as natural disasters or supply chain disruptions could cause a temporary or long-term decline in revenue for the company. There can be several reasons why a company's cost of goods sold might increase. For example, the cost of raw materials may increase due to changes in market conditions or supply chain disruptions, resulting in a higher cost of goods sold for the company. Alternatively, the company may be operating at capacity or using less efficient production methods, leading to higher production costs. In addition, an increase in transportation costs, changes in regulations or taxes, or an increase in packaging costs can also contribute to an increase in the cost of goods sold. If the gross profit margin has been decreasing over time, there are two possible reasons for this trend. Either the company's revenues have increased, or its cost of goods sold has decreased. There could be several reasons for a company's revenue growth. For example, the company may sell more products or services, resulting in an increase in sales volume and revenue. Alternatively, the company may increase the price of its products or services, leading to an increase in revenue per unit sold. Additionally, the company may introduce new products or services, expand its operations into new geographic markets or customer segments, or invest in marketing and advertising campaigns to attract new customers and increase revenue from existing customers. The company may also form strategic partnerships with other companies to cross-sell products or services, leading to an increase in revenue. Another possibility is that the company may decrease the price of its products or services, but experience an even greater increase in sales volume, leading to a net increase in revenue. There can be several reasons for the company's cost of goods sold to decrease. For example, decreasing labor costs, increasing employee efficiency, increasing equipment productivity, decreasing raw material prices, as well as optimizing the supply chain, reducing waste, improving quality control processes, and implementing more cost-effective manufacturing techniques. If the gross profit margin has stable dynamics over time, it still does not mean that the company's revenue volumes and cost of goods sold have remained unchanged. The gross profit margin over time can have stable dynamics when the volume of income and cost of goods sold change at the same rate. For example, when the volume of income increases by 2%, and the cost of goods sold decreases by the same 2%. Therefore, analyzing only one financial ratio and making decisions based on it can be wrong. And calculating many financial ratios at once, comparing them with different timeframes will take a lot of time. The solution to this can be interactive dashboards, which will allow you to analyze several financial ratios at any time, as well as study the dynamics of financial indicators for the same period. ControlZenith Consulting offers interactive dashboards with interactive reports, predictive analytics and financial models. Using our services you can get everything you need to assess the status of the company and effective management. We can help you create any type of dashboard in your desired format, such as financial status, company development, cash flow, employee performance, project status, investment, sales and other dashboards. Reports can be in any format and structure you like. They can include the group of data and you can choose the period from your dashboard. Forecasting models will enable you to forecast your revenues, expenses, profits, etc., which can help you set targets and make the right decisions. Analysis and modeling of corporate finance will provide an opportunity to find out the factors affecting sales volume, prices, and other indicators of the company. Subscribe to our YouTube channel, and like or dislike the video so we can understand whether you liked it or not. Also, leave a comment on which financial ratio we should make a video about next time. And in the next video, someone who left a comment and subscribed to our YouTube channel will be chosen at random and will be given 50% off the interactive dashboards we offer. ControlZenith Consulting, your efficiency guarantor.